All right, chapter 4. Here we're getting down into the nitty-gritty of what it takes to, some of the things it takes at least, to be a tax practitioner, to be able to advise clients on things such as what income's exempt, what income has to be included, what their filing status is, things like that. All right, so learning objectives, be sure you look at those if you want to. All right, so we start with this tax formula, individual income tax formula. Much different if you're talking about a business entity, but here individual, to figure out how much tax they owe, this is the calculation. It starts with gross income. You start with a positive number of gross income, and what you're going to do is deduct from gross income this thing called 4 AGI deductions. And if you will, look at Exhibit 4-2 on page 3 of Chapter 4. You got your introductory stuff, name, social security numbers, dependents, filing status, and all that stuff. But below that, you have income. So that would be the gross income part. The biggest part for most working individuals is wages, salaries, and tips. But it could include other stuff as well. Could include taxable interest, could include ordinary dividends, could include qualified dividends, alimony received, business income, capital gains, and other stuff. And so, again, line 7 through 21 are the things that are included in gross income. And, of course, line 22 is the total of all those various items of income. The stuff below line 22, line 23 through 35, are these 4 AGI deductions. Most of these are related to, well, business or employment, things like that. That's not totally true, but generally that's what the 4 AGI deductions consist of. Now again, we'll get more into detail on some of this stuff later, but we're just, again, this is an overview. All right, so note that what you're going to do in line 36 is you're going to add all these deductions for AGI together, and you're going to take line 36 and subtract that from line 22 to come up with adjusted gross income in line 37. Okay, so if you move to page 4 of chapter 4, you've got the second page of your Form 1040, which is an individual tax return. And so the stuff labeled as tax and credits are all those from AGI deductions. So what you're going to do is you're going to take your adjusted gross income, and from adjusted gross income, you're going to deduct from AGI deductions. The main AGI deductions from AGI deductions are the greater of the standard deduction or itemized deductions. We'll look at that in greater detail. And on top of that, personal and dependency exemptions. And so there's some other stuff in there, other taxes, and then of course you get credit for any payments you make. If you're a working stiff who works for somebody else, that somebody else, your employer, is going to take out of your wages taxes owed. The federal tax system is a pay as you go system. And so employers are required to take taxes out, both income taxes and employment taxes, out of your income. That's where you get gross income on your pay stub, less all these taxes, and there might be some voluntary stuff in there, retirement stuff as well. And so the amount you actually receive is your net payment. But anyway, adjusted gross income less the from AGI deductions equals taxable income. Once you've figured out your taxable income, you look at the tax tables to figure out what tax you owe. And so here they have taxable income times the tax rates. Again, that's the stuff at the back of the book. Federal tax rate schedule depends on your income, taxable income, as well as your filing status. Okay? So this is a broader view. Taxable income times tax rates equals income tax liability. You add other taxes, that equals your total taxes, minus credits, minus prepayments that I just talked about. That's the main one. Equals taxes due or possibly a refund if you've overpaid. And again, individuals report taxable income to the IRS on Form 1040, although there are a lot of related forms and schedules that might be attached depending on the type of income you have, deductions, etc., etc. Now, what is gross income? Well, if you look at Internal Revenue Code Section 61A, and again, the Internal Revenue Code is fairly general and vague sometimes in its application, so you have to go to other sources such as the regulations, the tax regulations that are related to the particular code section to find out details. But, and again, I encourage you, if you're really interested in this stuff, get familiar with the Internal Revenue Code. There's plenty of ways to do that online. IRS has lots of resources that you can use. Get familiar with how the regulations relate to the Internal Revenue Code. But anyway, when they talk about gross income, you look to Section 61A, and It essentially says that it includes all realized income from whatever source derived. So that's pretty broad. I mean, now they do, and you have to include sources of income as gross income unless the Internal Revenue Code specifically excludes it from gross income. And so realized income is where there has been some transaction between two parties, and there's also a measurable right in the party's ownership rights. Okay? Now, let me give you some examples where you don't have realized income, thus not part of gross income. Your stock portfolio increases in value from what your original purchase price was. And so it's worth more at the end of the year than it was at the beginning of the year. You haven't sold any. It's still sitting there. That is not realized income. Your house appreciates in value, but yet you still live there. You haven't sold it. So the appreciation is not taxable until you actually have a transaction between yourself and another party. That's what's going to trigger this. And there has to be some measurable change in ownership interest. Now, there are certain types of income that, and again, you have to understand how the tax code works. It's passed by Congress, signed, if approved, by the president. These are tax laws. The other thing that's pretty unique is the fact that right now we're working under the Internal Revenue Code of 1986. Okay, so there's been, that was the last big change in the Internal Revenue Code. But there's been several additions, subtractions from the Internal Revenue Code of 1986 since then. And so what they say, what experts talk about, is the fact that the Internal Revenue Code is a patchwork of various laws. They add and subtract different sections or subsections as they see fit, as Congress sees fit. And again, you have to include in gross income all realized income unless Congress specifically excludes certain income. And again, really, it's a matter of whether they exclude the income permanently or simply exclude it until a later date. What type of income would be an example of income that's permanently excluded? Well, Congress, and again, you could almost say that the Internal Revenue Code is an effort in social engineering. They're trying to encourage certain behaviors of taxpayers, and in some cases trying to discourage certain behaviors of taxpayers. And so one example of income that's excluded from the gross income amount is this thing called municipal bond interest. What's an example of a municipal bond? This would be a bond issued by a county, city, county, or state subdivision entity. Those types of bond interest are excluded from gross income. We saw that in chapter 2, that because that's excluded from gross income, city, state, and local, or excuse me, city, state, and county governments can actually pay a lesser percentage in interest compared to interest paid on, for instance, corporate bonds. So they're trying to favor these municipalities. There are types of income that you don't permanently exclude, but you exclude for a period of time. A good example of this that we'll talk about later are like-kind exchanges. So it's just deferred to some later tax year. Now, you also, when you're determining income, you have to decide the character of the income. And so let's talk about character of income. We talked about tax exempt. Municipal bonds are tax exempt. Tax deferred, that's the like-kind exchange example. Ordinary income, that's your wages and salaries and things like that. Qualified dividend, good example of that is when you own shares of a corporate stock and the corporation pays a dividend. That dividend is taxed at a favorable rate compared to ordinary income, and in general is paid at a rate of 15%. Although there are exceptions. Capital gain or loss. You sell a capital asset. Special term of art that we'll talk about in the future. If you have a capital gain on the sale of a capital asset, that gain is taxed at a preferential rate. If you have a loss on the sale of a capital asset, you're limited in the amount that you can deduct, and that deduction is limited to a $3,000 offset against other ordinary income of the taxpayer. All right, so let's talk a little more about 4 AGI deductions. You might hear the term above the line deductions. Those are 4 AGI deductions. These deductions are taken away from income items, subtracted from income items to come up with adjusted gross income. They always, unlike from AGI deductions, which are limited, they're not a dollar. From AGI deductions are not a dollar for dollar deduction from gross income. For AGI deductions are a dollar for dollar reduction in gross income. Again, some examples. For the most part, they're work related or employment related or investment related. But if you look at Exhibit 4-5, moving expenses, something we'll talk about in more detail. Health insurance deduction for self-employed taxpayers. Rental and royalty expenses. Capital losses. 1/2 of self-employment taxes paid. Business expenses, we'll talk more about that. Losses on disposition of assets used in a trade or business. Contributions to a qualified retirement account. So most of those are either investment or work related. Alimony paid, we'll talk more about that. That's an interesting topic. Certainly not employment or investment related, but for some reason Congress has deemed the payment of alimony to be a for AGI deduction. Maybe to favor themselves, I'm not sure. Deductions from AGI, and again, that consists of deductions, either the greater of standard deduction or itemized deductions, as well as personal and dependency exemptions. These are considered below the line, meaning after you determine what your AGI, you deduct these from AGI deductions. So they ask here, why might a from AGI deduction not reduce taxable income? And I'll let you figure that answer out. For 2015, which is what this book is all about, again, we're here in 2016, but the tax returns that are going to be due individually, anyway, by April 15th, unless the taxpayer files an extension, is on income earned during 2015. So here we have the standard deduction amounts. Note that standard deduction depends on your filing status. Married filing jointly, $12,600. Same for a qualifying widow or widower. Married filing separately, exactly half of that. Single, exactly half of that. And then kind of an intermediate status called head of household. Note that additional standard deduction amounts are given for age and eyesight. which we'll discuss in Chapter 6. We've talked about this before. In the U.S. tax structure, we use a progressive tax rate schedule. Again, some items are taxed at preferential rates. Long-term capital gains are taxed lower than ordinary income. Qualified dividends are taxed at a lower rate than ordinary income. And so the tax on these items is calculated separately from the income taxed at ordinary rates. Well, that makes sense. And again, the exemption deduction, both personal and dependency exemption, are $4,000 each in 2015. Look at, if you will, example 4-3 and 4-4 for some good examples of the income tax calculation. Now, some other taxes that might or might not be relevant is something called the alternative minimum tax. We're not really going to be studying that in detail at all, but the idea behind the alternative minimum tax is that Congress deemed that every taxpayer should pay a certain amount, and they saw a lot of taxpayers using a lot of itemized deductions to reduce their tax liability to very little or maybe nothing. And so this alternative minimum tax is for these individuals who have a lot of itemized deductions. And so if you have that situation, of course, you know, if you've got a good tax software preparation program, say it in a different way, tax preparation software program, it's going to do this stuff for you anyway. It's going to calculate the alternative minimum tax. And if you owe more after calculating the alternative minimum tax than you would with just the regular way, you're going to pay that alternative minimum tax amount. If you're self-employed, you might have self-employment taxes. We'll talk about that some. And these last two are fairly new taxes. Don't know if we'll have time to talk about them, possibly. And then tax credits. Probably the most utilized tax credit there, I think, is something called a child care tax credit. If you have such a type of tax credit, there are others. These are a reduction. The amount is a reduction off the amount of tax owed, and it's dollar for dollar reduction. And again, tax prepayments, we've got a pay-as-you-go system, so those are taken into consideration and deducted in figuring out the amount of any additional tax liability, or possibly if the prepayments are greater than tax liability, then there could be a refund. All right. Personal and dependency exemptions. This is a pretty interesting subject. The taxpayer gets a personal exemption of $4,000, which reduces from AGI. And if they're married, they get an exemption for their spouse as well of $4,000. And then if they have a qualifying dependent or dependents, they get a deduction, or an exemption deduction for each qualifying dependent. And again, each exemption is $4,000 for 2015. Now, there are two types of dependency exemptions. There are qualifying child dependency exemptions and qualifying relative dependency exemptions. Both qualifying child and qualifying relative, if they meet those requirements, must be a citizen of the United States or a resident of the U.S. or a resident of Canada or a resident of Mexico. On top of that, to be a qualifying child or qualifying relative, they must not file a joint return, these qualifying dependents, with a spouse, unless there's no tax liability filing jointly or separately. Now, what is an example of that? Let's say you've got a 20-year-old daughter who's married to this guy and together they don't make much income and they don't have a tax liability. And on top of that, you're basically supporting them. You could, in that instance, if you have all the other qualifications, claim your 20-year-old daughter as a qualifying dependent. Last but not least, and this is the one that gets tested over the most often, is that the qualifying dependent must be a qualifying child or qualifying relative. Okay? And what usually happens, and again, that's usually the issue, not the first two, you've got two sets of rules. And in application, if you have a child that's yours, you usually look to see if they qualify as a qualifying child. And if they meet the requirements, perfect. That child is a qualifying child and therefore a qualifying dependent. And you get to take an exemption for them. Now, qualifying relative is broader than qualifying child and includes other family members, and in certain circumstances even includes non-family members. Kind of strange. So, and the main point is, even if you have a child who doesn't meet the requirements of a qualifying child, you still would look to see if they are a qualifying relative, because two different rules here, set of rules for each. All right, so let's look at qualifying child. You have to meet the relationship test. And so the child has to be a child or descendant of a child, meaning a grandchild. And child includes adopted child, stepchild, and eligible foster child. It can also include, this qualifying child, a sibling or descendant of a sibling. Now, this is a sibling of the taxpayer or a descendant of a sibling of the taxpayer. Well, who would that be? Well, that would be a brother or sister or a descendant of a brother or sister, meaning the taxpayer's niece or nephew. And it includes, a sibling includes a half-brother, half-sister, step-brother, or step-sister. On top of that, and again, they must meet all 4 requirements here, okay? They must meet the relationship test. They must meet the age test. Must be younger, the qualifying child must be younger than the taxpayer. That's usually a no-brainer. And either under the age of 19 at the end of the tax year or under the age of 24 and a full-time student. And they define a full-time student as anyone who is in school full-time during any part of each of five calendar months during the calendar year. So they could basically be off 7 months from school and still qualify. And notice it says during any part of 5 calendar months during the calendar year. Note here, if you have a permanently and totally disabled child, they automatically qualify and meet the age test even if they're 30. So that's pretty good. They must meet the residence test. The qualifying child must have the same principal residence as the taxpayer for more than half the year. Now there's an exception for that. Let's say they are away in school. So as long as that's their primary residence, even when they're away from school, the temporary absence while they're on campus still qualifies them as a qualifying child. And then last but not least, the qualifying child must not have provided more than half of his or her own support for the year. Now note, it doesn't say anything about the taxpayer having provided more than half the support for the year. It just says that the qualifying child must not provide over half of his or her own support. Note that scholarships are excluded from the support computation. And so we have an example here. Rodney and Anita have 2 children, Braxton, age 12, who lives at home, and Tara, age 21, who is a full-time student and does not live at home. While Tara earned $9,000 in a summer job, she did not provide more than half her own support during the year. Are Braxton and Tara qualifying children to Rodney and Anita? And so here you kind of have to assume that they meet the first two requirements, that they're citizens of the United States or residents, and neither is filing a joint return with a spouse. Doesn't indicate either one is married, and one's 12 anyway. And it gives you the fact that Tara did not earn or did not provide more than half her own support during the year. The other issue is she's a full-time student and does not live at home, and so that would be considered a temporary absence from home. And so here's how you handle that. Both of them meet the relationship test. One's a son, one's a daughter. Age test, one's less than 19 at year end, the younger one. The older one, less than 24 and a full-time student, and certainly younger than her parents. Residents, the 12-year-old lived at home the entire year. And again, for the daughter, temporary absences such as school is okay. Support, 12-year-old, not a problem. The daughter, even though she earned $9,000, it states she did not provide more than half her support. And so both qualify as a qualifying child. You could get into these tie-breaking rules. Usually this is a case where you've got a divorced couple who both provide support to a child, and so you have these tie-breaking rules. The big one is the last two, days living with each parent if parents living apart. The one with the most days living obviously gets the qualifying child exemption. The higher AGI gets the exemption. And I think these are kind of in that order. You look at the days living first. If it's even, then you look at the higher AGI. Here we have an example of Braxton's uncle Sean. Rodney's brother lived in the Hall's home. The same time, the same home Braxton lived in for more than 11 months during the year. Does Braxton meet the requirements to be considered Sean's qualifying child? Kind of a confusing example. So, relationship test. Braxton is the son of Sean's brother, less than 19. Residence test, yes, lived in the same residence as Sean for more than half the year. And last but not least, support. Braxton does not provide more than half his own support. And so in this instance, Braxton is considered to be Rodney and Anita's qualifying child, and he is considered to be Sean's qualifying child. Under the tiebreaker rules, which is kind of what their gist is here, who is allowed to claim Braxton as a dependent for the year? Well, I think that would be Rodney and Anita under the first tie-breaking rule. Parents get priority over others. Now, what happens if Rodney and Anita aren't alive? Well, then that's a different story. The uncle would get the exemption. Now, what happens if you've got a child who you're supporting, but they're over the age of 19, or they're in school still, and they're over the age of 24, or they're, I guess actually it would be 19 or older or 24 or older? Well, all may not be lost. Obviously, they wouldn't qualify as a child. They wouldn't be a qualifying child, but they might be a qualifying relative. So you go through the test to determine whether or not they're a qualifying relative. In order to be a qualifying relative, you have to meet 3 tests. First is the relationship test. Second, the support test. And third, the gross income test. And so looking at the relationship test, again, this is more inclusive than qualifying child and includes even non-relatives. And so a person is related to the taxpayer under qualifying relative relationship test is if the person is a child, grandchild, parent, or grandparent, a sibling of the taxpayer, including a stepbrother or stepsister, a son or daughter of the taxpayer's brother or sister, meaning nephews and nieces to the taxpayer, but not cousins. A sibling of the taxpayer's mother or father, that would be the taxpayer's uncle or aunt. An in-law, mother-in-law, father-in-law, sister-in-law, brother-in-law of the taxpayer. Or, this is where the unrelated party comes in, an unrelated person who lives in taxpayer's home for the entire year. On top of the relationship test, the qualifying relative must be supported by the taxpayer for more than half of the qualifying relative's living expenses. And again, scholarships are excluded. The gross income test. The qualifying relative's gross income must be less than the $4,000 personal exemption amount. that usually right there is a deal killer. However, let's see. So look at Exhibit 4-8 on page 18. This gives you your summary of dependency requirements. And just kind of be familiar with those and have it handy when you're doing these problems. Okay? We'll take a break and come back at it here in a few.